Today is all about debt versus equity and what is the right investment for you when investing in property development deals. Now, I think it all depends on your situation, whether you need cash flow, whether you need certainty over when you're going to get your money back, and also your risk appetite. Are you happier to take a higher risk but for higher return? So let's take debt and equity one by one. Equity first. What is equity? Well, if you're an equity investor, you're usually a shareholder in a limited company that is actually doing the property development, and your return is directly linked to the asset that you're investing in. So, for example, if you are investing in a build of 10 houses, the return that you get will be linked to the revenue that those 10 houses will produce. So equity is typically seen as higher risk, but therefore higher return. But also you do tie up your money. So if cash flow is an issue, I wouldn't go for equity. If you need your money back by a certain time, again, equity can be uncertain. There'll be projected dates when you should get paid, but you know, that's not a given, that's not a certainty. So let's take debt. So debt isn't, your return is not based on the performance of the asset. Instead, it's a loan to the developer, and the developer pays interest. Now, whether that be in installments or whether that be rolled up and paid to you at the end. But the risk with debt is that the developer could go bust. And there are certain safeguards that you can put in place. For example, you can take security over the property. So if the developer does go bust, you can enforce your security, enforce the sale of the property and get your money back that way. Or you can ask for a personal guarantee. So if the developer's company goes bust, you can look beyond the company and look into their other assets to try and recoup your costs. But debt is typically seen as less risky. Debtors get paid their money out before equity holders do, what they do in the UK anyway. It's seen as less risk, but therefore the returns are less. It's also usually for a fixed period of time, so that you've got some kind of certainty about when you're going to get your money back. Again, for this advantage, you do get a lower return. But I would say if cash flow is something that you really want, then you can get interest paid in installments to satisfy that. And if you need your money back by a certain time, then debt can also help you out there. The only one thing I would say with debt, though, is please take into account inflation when you lend anyone money. For example, if you're lending a loan and it's on 10% and inflation is 3% a year, you just need to be aware that actually you're not getting 10%, you're getting 7%, and that will only get worse as the years go on. So that's something that people don't actually necessarily factor in when they're talking about debt. But just to sum up, in conclusion, which is better? Well, I actually think a combination of the two is probably better. You want to diversify your portfolio, so if you can do a bit of equity, higher risk, have your money tied up for longer, with a bit of debt, which is lower risk, more certainty, can get a bit of a cash flow going, then that's the ideal situation. Thank you. Bye.